What's up, Warren Money family? Today I'm going to share something that might shock some of you dividend lovers out there. I completely sold out of SCHD, better known as SCHD, the Charles Schwab High Dividend Fund. I did all this in June and it was hands down the best investment decision I've made this year. Now, before you click away thinking I've lost my mind, let me show you exactly why this move was pure genius and why, as a Generation Xer who is over 50 years old, I have now realized dividend investing was holding me back from real wealth building. In this video, I'm going to pull up Seeking Alpha and Morningstar and show you some other gems so you can see exactly what I'm talking about. And I'll show you my actual trading records, and the numbers that I'm about to show you is going to blow your mind. Like a trade I put on exactly 1 week ago that is up 22.68%. I did not stutter. 1 week, 22.68% return. Let's start with the elephant in the room. SCHD's terrible performance in 2025. As you can see here, we're comparing SPY versus SCHD, the performance comparison. Past 6 months, SCHD negative 1.89, SPY 5.85%. Year to date, 7.93 for SPY, 0.51 for SCHD. 1 year, 15.96 versus 3.43. 5 year, 106 versus 78%. 10 year, 258% versus 195%. That's negative, 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 negative. So negative returns while the S&P 500 is sitting pretty at over 7% gains for the year. Again, here's a look of the return by period. Year to date, 7.77%. Underperformed. Expense ratio 0.06 versus 0.09%. If you look at SPY versus SCHD risk-adjusted performance ranking, this tells us the risk-adjusted ranks indicate the investment's position relative to the market. A rank closer to 100 signifies top-performing investments, while a rank closer to 0 might suggest underperformance. SCHD 25, 57, lower 25% quartile versus other ones. SPY is beating better than half of other funds out there. Here's a risk-adjusted performance comparison and a Sharpe ratio, which we will get into later. Now switching over to Morningstar with me. Look at this performance ranking here. Year to date, 99%, 77, 89, 29, 19, 3, 29, 19, 9, and 30. So as you can see, these numbers are different. Let me explain this. So essentially, year-to-date, 99 percentile for year-to-date returns. That means that 99% of its peer funds are beating it. This fund has gone from being a dividend darling to a certified underperformer. So it was in the top 3 in 2020, and it slowly has gotten worse, as you can see. But the real wake-up call came with their March 2025 Reconstitution. This was possibly the worst time portfolio shuffle in ETF history. Right in the middle of Trump's tariff uncertainty, they decided to completely overhaul the fund. Let me show you the numbers on Morningstar. Energy exposure jumped from 12 to 19%. They doubled down on oil and gas companies like ConocoPhillips and Schlumberger right as energy prices started tanking. Meanwhile, they slashed their financial sectors. As you can see, it went from 17% down to just 8%. This wasn't strategic rebalancing. This was a panic move that backfired. The energy sector has been one of the worst performers since April, dragging SCHD down. They essentially bought high on energy stocks right before they crashed. Now, don't get me wrong, I am bullish on some energy stocks. If you have been following me along and the subscribers to my Substack know that I have been dollar cost averaging into a secret AI energy play, ExxonMobil. I do have a breakdown on Exxon versus Chevron video, and I also have a breakdown on Exxon. I have rebalanced my DCA into that stock due to recent events, and you get all these trade alerts from my Substack. But please check out those videos. Breaks it down how I'm using AI not only to figure out what trades to put on, but once I do add stocks to my portfolio, I do use AI to look at my portfolio. Do I want to sell? Do I want to buy more? Do I want to slow down my DCA? Here's a closer look at that March portfolio rebalance for SCHD. Additions: Merck, ConocoPhillips, Schlumberger, Target. Other additions including General Mills. These additions reflect a preference for higher yielding stocks with solid dividend histories. Deletion: 17 stocks. Pfizer, BlackRock. BlackRock is a stock I like. U.S. Bancorp, M&T, KeyCorp, Huntington, Zions, Synovus. Other deletions: H&R Block, Tapestry, and Dick's Sporting Goods. Those removals suggest a rebalancing to prioritize higher yields and stronger fundamentals over stocks with weaker growth or valuation metrics. Here's a sector allocation that we talked about: energy sector surge, financial reduce, healthcare adjustments, Pfizer's exit, and Merck's entry, consumer defensive and discretionaries. No single sector can exceed 25% of this index, but energy is pretty notable. Here's something most dividend investors refuse to acknowledge. We're living in a completely different interest rate environment now. When you can get 4.6% in a risk-free money market fund, why would anybody settle for SCHD's 3.79% dividend yield, which comes with significant principal risks? Let's look at the comparison on Seeking Alpha with similar funds. So as you can see here, we have SCHD, Vanguard High Dividend Index Fund, iShares Core Dividend Growth Fund, Vanguard Dividend Appreciation, iShares Core High Dividend, and iShares Select Dividend. Over 1 year, SCHD negative 0.4. Year to date, SCHD negative 1.35. BYM 5.5, 5.49, 5.28, 5.9, 3.36. 1 year, negative 0.4. 9.5%, 8.5, 9.3, 6.26, 6.43. 3 year, SCHD 11, 30%, 31%, 38%, 18%, 15%. Underperformed. 5 year, 50%, 64, 64, 67. Hey, it beat this one, 41%, 62%. 10 year, 109. It beat 97, 145, 156, 59, and 77. So as you can see, over the course of anywhere from year to date to 10 years, SCHD has underperformed. Not only that, right now, the 10-year treasury is yielding around 4.9%, while SCHD is sitting at 3.79. That's a negative spread. You're getting paid less to take on more risk. That makes zero sense from a risk-adjusted return perspective. The Fed has made it clear rates are staying higher for longer. This creates a massive headwind for dividend stocks, especially the rate-sensitive sectors that SCHD is overweight in. When risk-free alternatives offer better yields, dividend stocks become obsolete. As you can see here in this article from Investopedia, the risk of chasing high dividend stocks. Key takeaways: a high dividend yield might indicate a business in distress. Investors should scrutinize a company's ability to pay consistent dividends. Dividend stocks are vulnerable to rising interest rates. As rates rise, dividends become less attractive compared to the risk-free rate of return offered by government securities, which I talked about with the 10-year treasury. High dividends can be fool's gold. I suggest you go and read this Investopedia article, Interest Rate Risk. Now let me get personal for a minute. I'm over 50 years old, and everyone says I should be focusing on income and capital preservation. Capital preservation is very important. But here's the hard truth. I've got at least 5 years until retirement, and most people my age have 10 to 20 years. And with possibly 30 years left of life expectancy, at this stage, I need growth, not a measly 3.79% yield that barely keeps up with inflation. Now let's do some simple math here. Here's a smart asset calculator. If I invest $100,000 with a zero annual contribution, now keep in mind, for all you SCHD lovers out there, you're going to put in the comments, but we reinvest our dividends. Okay, fine. But for simplicity, I'm not going to include that. But for you SCHD lovers out there, yes, that's what you want to do. You want to reinvest those dividends, and this return sum will be higher. But for simplicity, I'm just going to say put zero here. Stay with me. Rate of return 7.43% with 15 years ago results in $293,000. That's $193 $100,000 return. Let's go up here and let's look at the S&P 500. Starting with 100, 0 return. Now those SPYs and VOOs, you get dividends too. So this would be higher also. 13.43% average rate of return with 15 years is $662,000. That's $562,000 for total growth. That's over $350,000 that we are leaving on the table by prioritizing dividend over growth. The psychological trap of dividend investing is that you feel good getting those quarterly payments, but you're getting poorer in real terms. Inflation is eating away at your purchasing power while you're celebrating that measly 4% yield. Here's what confirmed my decision. Look at the smart money inflows. Despite SCHD taking in billions in new money for retail investors, institutional investors have been quietly rotating out of dividend strategies. VOO, 65 billion, iShares Treasury, 17, Vanguard Total Stocks, 15, Spider, 13, Bitcoin, 10, all the way down here, SCHD, 5, 65 to 5, even Bitcoin, 10 to 5. The performance data shows this clearly. Dividend strategies have had exactly one good year out of the last 8 compared to the broad market. The Morningstar Dividend Leaders Index only outperformed in 2025 because tech stocks stumbled, not because dividend stocks got better. Meanwhile, look at what's happening in the AI and technology space. Companies like NVIDIA are reshaping entire industries, creating wealth at a pace that dividend stocks simply cannot match. By staying in SCHD, I was essentially betting against the future of innovation. Now let me show you actual trading records. That's what we do on this channel. I'm not like all these other channels that are going to say, invest in this stock, and who knows if they're doing it or not. I'm actually showing you my Fidelity account. These are screenshots of the actual trades that I made. Because we're going to walk through. December 18th, about 100 shares. January 6th, another 200. March 12th, another 100. Here on February 14th, I sold out of 100. June 27th, here's where I sold all of my position of 500 shares at 26.48. And if you look here, I bought 27.78, 27.44, 27.45, ended up selling for a loss. Now keep in mind, I was getting nice dividends here, like this one, $130. So it wasn't that big of a loss, but it was a loss. So my final sale in June at 26.48 represented essentially flat returns for months of opportunity costs. Now here's the key. While SCHD was going nowhere, growth stocks in the broader market were taking off. So by reallocating that capital into QQQ or even SPY, or in my case, Ethereum, as you can see, July 14th, I bought 160 shares of that fund. I'm up a whopping 22.68% in 1 week. Today is July 21st. That's July 14th. 1 week, $800 return. That is more than a 6x of this $130 dividend. Data shows SCHD's Sharpe ratio at 0.23% compared to SPY's 0.74. That means SPY is delivering better risk-adjusted returns. So why would I accept inferior returns for similar risk? Finally, let's talk about SCHD's dangerous sector concentration. With 21% in energy and heavy weightings in utilities and financial, this fund is essentially a bet on old economy sectors that are being disrupted by technology and clean energy transitions. The March Reconstitution made this problem worse, not better. They're doubling down on sectors that face secular headwinds while underweighting the technology and innovation sectors driving real economic growth. Look, I get it. Selling SCHD feels scary because it's been the safe choice for so long. But the data doesn't lie. This fund has become a wealth destroyer, not a wealth builder. As a person who's over 50 years old, I can't afford to play it safe anymore. I can't afford mediocre returns. If you're under 60 and have a long investment horizon, seriously consider whether dividend investing is holding you back. The opportunity cost is simply too high in this environment. Drop a comment below. Are you still holding SCHD, or have you made the switch to growth strategies? Check out my latest breakdown video on SLV. I might have just deployed some significant capital to SLV. and I already gave away my ETH trade to you. If you want to see my portfolio and trade alert, check out my Substack. Link is in description. Remember, it's not about timing the market. It's about recognizing when your strategy isn't working and having the courage to change course. Until next time, keep building that wealth the smart way and stay tuned for more breakdown videos like this.